Bank of America names new executives to lead its digital asset and tokenization push. Bank of America has appointed new executives to lead and scale its digital asset platforms, tokenization business, and AI transformation, according to a July 18, 2026 report shared by Watcher Guru. The move puts named leadership behind a set of initiatives the bank had mostly described in general terms until now. The framing matters more than a typical personnel note. Assigning senior people to own digital assets, tokenization, and AI as distinct mandates is how large banks convert exploratory work into funded roadmaps with deadlines. This is the point where a research topic becomes a business line with a P&L. An institution the size of a small economy moving on-chain. Bank of America is the largest U.S. bank by domestic deposits and one of the largest by assets, serving retail customers, corporates, and institutions. When an institution of that scale creates dedicated executive roles for tokenization, the practical question is not whether it will experiment, but which asset classes get moved onto a ledger first. Tokenization at a bank of this size usually starts with the least controversial instruments: money market funds, U.S. treasuries, and short-term cash products, where the settlement and collateral benefits are clearest. That mirrors what other institutions have already done. BlackRock, Franklin Templeton, and a growing list of asset managers have put tokenized treasury and money market products into production. And infrastructure players like DTCC have begun soft-launching tokenization rails for U.S. equities, ETFs, and treasuries. The digital asset platform mandate is the broader of the two. It can cover custody, stablecoin settlement, tokenized deposits, and the plumbing that lets institutional clients hold and move blockchain-based assets under a regulated roof. Banks tend to treat this as infrastructure they must own rather than outsource, because custody and settlement sit at the center of their client relationships. Timing lines up with a friendlier U.S. rule set. The appointments arrive as U.S. market structure legislation moves through Congress. The Clarity Act, which would divide oversight of digital assets between the SEC and CFTC, has drawn public support from lawmakers and federal law enforcement groups. And one representative recently described it as on the 1-yard line. A clearer split of regulatory authority lowers the legal ambiguity that has kept many banks cautious about holding or issuing digital assets directly. Stablecoin rules are firming up in parallel. The US and UK published a 10-point roadmap to align stablecoin and tokenization standards, and Europe's MiCA regime continues to license payment and stablecoin providers. For a bank weighing how much capital to commit, a defined rulebook is often the deciding input. Naming executives now, rather than after the legislation passes, suggests Bank of America wants its teams built before the rules land, not after competitors have a head start. Second-order effects for payments and cards. Bank leadership over tokenization and stablecoin settlement eventually reaches the consumer layer, including how people pay. Much of today's crypto-linked spending runs through fintech issuers and crypto cards that convert digital balances to fiat at the point of sale. If a major bank builds native tokenized deposit and stablecoin rails, some of that settlement could move onto bank infrastructure rather than third-party processors. That would not remove the disclosed and hidden costs users already face. Card spending still carries network spread, conversion costs, and the counterparty question of who holds the underlying balance. It could, though, shorten the chain between a tokenized asset and a merchant payment, which is the same efficiency argument driving institutional interest in tokenized cash for settlement. For now, the concrete fact is narrow. Bank of America has put named executives in charge of digital assets, tokenization, and AI. It has not disclosed specific products, launch dates, or asset targets tied to these roles. Everything beyond the appointments is inference from how banks typically staff before a build, and should be read that way.